Silver and gold are entering a period that could become one of the most important chapters in the precious metals market in decades. But the biggest story may not actually be silver itself. It may be what is happening underneath the financial system. Because while investors are watching silver approach the $70 level, something much bigger is happening in the U.S. Treasury market. The government has begun expanding its bond buyback operations as long-term yields remain elevated, and the market is questioning whether these measures can actually solve the underlying fiscal problem. Recent reporting shows the Treasury doubled planned buybacks to at least $4 billion per operation, while gold moved sharply higher as the dollar weakened and concerns about U.S. debt increased. And that creates the first major question for precious metals investors. Are we looking at a temporary market intervention or the beginning of something much bigger? Because if the Treasury has to become increasingly active in the bond market to control financial conditions, investors need to pay attention to what happens next. The transcript we're analyzing makes a very aggressive argument that the initial Treasury intervention could be only the beginning and that eventually much larger measures may be required. That is an interpretation, not an established fact. But the underlying market signal is real. Long-term Treasury yields remain elevated, and the government is actively trying to improve liquidity and manage volatility. And this is where gold becomes extremely interesting. Gold doesn't need a financial crisis tomorrow to benefit from concerns about debt. It can respond to something much more gradual: declining confidence in government finances, weaker real returns on bonds, currency concerns, and investors searching for assets that aren't directly tied to government liabilities. We're already seeing evidence of that shift. Gold recently pushed above $4,600 and approached $4,700 as concerns about U.S. fiscal conditions and Treasury policy intensified. And then there is silver. Silver is approaching a psychologically important $70 level. But the bigger argument is that silver sits between two worlds. Gold is primarily monetary, copper is primarily industrial. Silver sits somewhere in the middle, with both monetary characteristics and enormous industrial importance. That makes silver particularly interesting in a commodity cycle where monetary concerns and industrial demand can collide. The source transcript argues that today's environment resembles parts of the 1970s: geopolitical tensions, energy concerns, inflationary pressure, and enormous government debt. It also points out that silver's nominal price has risen dramatically from its 1980 peak, but not nearly as much as many other assets have appreciated over the same period. Now, that does not mean silver is automatically destined for a specific price target, but it does raise an important question. If the financial system continues moving toward higher debt, greater intervention, and monetary uncertainty, could silver eventually experience a much larger repricing? That is the open loop. Because one analyst cited in the source material has projected a potential $275 silver target based on a very long-term cup-and-handle technical pattern. That is a technical projection, not a guaranteed outcome. And it should be treated as a scenario, rather than a forecast we can assume will happen. But whether silver reaches $275 is not even the most important question. The more important question is why investors are suddenly willing to discuss numbers like that at all. And the answer leads directly back to the bond market. Because when a government has to spend more to service its debt, while investors demand higher yields to hold longer-term bonds, the cost of financing that debt can become increasingly difficult. That is exactly why Ray Dalio's latest warning has attracted so much attention. Dalio has warned that the U.S. could face a serious debt crisis within roughly 3 years, give or take 2, if the fiscal trajectory isn't addressed. He has also argued for reducing bond exposure and holding a meaningful allocation to gold as protection against debt and currency risks. And suddenly, the gold story becomes much bigger than a simple commodity trade. It becomes a question of confidence. Confidence in bonds, confidence in currencies, confidence in government finances, and ultimately, confidence in the financial system itself. So as we move deeper into this story, I want you to keep one number in mind: $40 trillion. Because that is roughly where U.S. national debt has now crossed, according to the recent market discussion. The transcript highlights that milestone as a critical backdrop to everything happening in Treasury markets. And if the debt keeps growing, while policymakers become increasingly active in the bond market, the question isn't simply whether gold goes higher. The bigger question is, what happens to gold and silver if investors begin believing that the financial system itself is entering a new era? That is where this story gets truly interesting. Now, this is where the Treasury story becomes much more interesting, because the first reaction from the market was surprisingly clear. When the Treasury announced that it would double the size of its long-duration bond buybacks, longer-term yields fell, the dollar weakened, and gold jumped sharply. Reuters reported that the 30-year Treasury yield had recently reached about 5.34%, its highest level since 2007, before falling after the buyback announcement. That sequence matters. Treasury buys bonds, bond demand increases, yields fall, the dollar weakens, and gold rises. That is the chain investors need to understand. But there is a problem. A $4 billion buyback may sound enormous to the average person, but compared with a treasury market containing tens of trillions of dollars of debt, it is relatively small. Reuters reported that the Treasury's increased operations are aimed at improving liquidity and reducing pressure in the long end of the curve, but they do not solve the underlying fiscal problems of deficits and debt servicing. And that brings us back to the argument in the source material. The transcript describes the intervention as a first step rather than a complete solution, comparing the debt problem to a massive fire that cannot be extinguished with a single hose. That is the speaker's analogy and interpretation, not an established forecast. But there is a legitimate market question underneath that argument. What happens if the first intervention isn't enough? Because Treasury Secretary Scott Bessent has already said the government could increase buybacks further if necessary, while maintaining the regular Treasury auction schedule. That is important because investors are watching whether these operations remain limited liquidity management tools or become a much larger policy response. And that distinction could have enormous implications for precious metals. Think about the mechanism. If long-term yields remain too high, policymakers face pressure because higher yields increase borrowing costs for the government and can also raise financing costs throughout the private economy. If the Treasury responds with larger purchases of longer-term bonds, yields could come under additional downward pressure. But lower yields can also reduce the relative attractiveness of holding interest-bearing assets compared with an asset like gold that pays no interest. And if the dollar weakens at the same time, the setup becomes even more supportive for gold. That is almost exactly what happened after the August 19th announcement. Reuters reported that gold surged more than 3% that day as the Treasury's move pushed yields and the dollar lower. Now here's where I want to slow down. It would be easy to say, Treasury buys bonds, therefore gold goes straight up, but markets don't work that way. If inflation rises sharply, bond yields can rise again even while the Treasury is trying to support the market, and higher real yields can create pressure on gold. In fact, Reuters reported that gold's latest move has been influenced by this exact tension. Expectations for lower real rates are supportive, while inflation concerns and the possibility of higher rates remain a headwind. So we have two forces fighting each other. On one side, debt concerns leads to Treasury intervention, leads to weaker dollar leads, to lower yields, leads to bullish for gold. On the other, higher inflation leads to higher rate expectations, leads to higher real yields, leads to potential pressure on gold, and that is why the Federal Reserve becomes critical. This week, markets are watching Federal Reserve Chair Kevin Warsh's upcoming Jackson Hole speech for clues about the future direction of interest rates, while inflation data could also influence expectations. Reuters says gold is currently sensitive to those developments, with spot gold recently around $4,646 an ounce and silver around $68.43. So the metals market is sitting at an extremely interesting crossroads. Gold is already responding to the possibility that financial policy could become more supportive. Silver is hovering near the $70 psychological threshold, and investors are simultaneously watching a treasury market that has experienced some of its most significant yield pressure in years. But there is another piece of the puzzle that the source transcript emphasizes heavily: the historical comparison with the 1970s. The argument is that the current environment has several similarities with that period: geopolitical conflict, energy problems, inflationary pressure, and enormous government debt. We should be careful here. History never repeats perfectly. The economic structure of the 1970s was different, monetary policy was different, demographics were different, and today's financial system is far more complex. But the comparison is useful because it asks a fundamental question: what happens to precious metals when investors lose confidence in the purchasing power of paper currency? That is the deeper silver thesis. Silver isn't just a metal sitting in a vault, it is also an industrial input. Solar panels, electronics, electrical systems, and emerging technologies all require silver, which means silver has a demand profile that is fundamentally different from gold. The source material describes silver as the middle child between monetary gold and industrial copper. And that combination could become increasingly important if the global economy enters a period where monetary demand for metals rises while industrial demand remains resilient. But there is one major warning. The source makes several extremely bullish claims about silver, including a potential $275 target and a 400-to-1 paper-to-physical ratio. Those are claims from the original commentary, and they should not be treated as independently verified facts without checking the underlying methodology and data. The more reliable signal is the broader market behavior. Silver has moved sharply higher, gold has moved sharply higher, and both are increasingly responding to the same macro forces. That may be the most important development of all. Because if gold and silver begin moving together, not simply because of their individual supply and demand fundamentals, but because investors are responding to a broader concern about currencies, debt, and financial policy, then precious metals are becoming part of a much larger macro trade. And that leads us to the next question. What happens if the Treasury's intervention fails to permanently calm the bond market? Because if yields come back higher, the dollar weakens further, and policymakers respond with even larger interventions, the implications for gold and silver could become much bigger than the market is currently pricing. But now we need to look beyond the first reaction, because the real question is whether the Treasury can actually control the long end of the bond market. The early market response was dramatic. On August 19th, the Treasury announced that it would increase the size of its longer-dated Treasury buybacks, and gold immediately jumped. The World Gold Council noted that yields and the dollar fell, while gold rallied about 3% after the announcement. But the follow-through is what matters. By August 25th, the U.S. 10-year Treasury yield was around 4.71%, while the 30-year yield remained above 5%. And Reuters reported that Treasury Secretary Scott Bessent intends to continue the normal Treasury auction schedule even while increasing buybacks of 10 to 30-year securities. That creates a very important distinction. This is not yet traditional yield curve control. The World Gold Council explicitly notes that the Treasury buyback program is not yield curve control, although some market participants see it as potentially moving in that direction. And that distinction matters because true yield curve control would involve authorities explicitly targeting a particular interest rate level and using purchases as necessary to defend that target. What we have right now is different. The Treasury says the buybacks are intended to improve liquidity and market functioning. But investors are asking a deeper question. If the market keeps demanding higher yields, how far will policymakers ultimately go? Because the United States has a gigantic amount of debt that must continually be refinanced. And when interest rates remain elevated, the cost of carrying that debt becomes increasingly important. This is why the $40 trillion debt milestone has attracted so much attention. Recent market reporting puts U.S. federal debt above that level, while simultaneously highlighting the pressure created by elevated long-term yields. Now imagine the following scenario. The Treasury continues buying longer-dated bonds. The Fed eventually becomes more accommodative. Inflation remains above target, and investors begin to believe that policymakers are becoming increasingly willing to tolerate a weaker currency in order to make the debt burden easier to manage. That is where the so-called debasement trade becomes important. It does not necessarily mean that the government announces, we are going to weaken the dollar. It can happen indirectly. If nominal debt keeps expanding faster than the economy, if real returns on safe assets become less attractive, and if investors believe policymakers will prioritize financial stability over maintaining a strong currency, capital can gradually move toward assets that are perceived as protection against monetary erosion. Gold is one of those assets, and silver can benefit as well. In fact, recent market reporting shows exactly why investors are watching this relationship. Gold and silver have both surged in August, while concerns about U.S. debt and the dollar have intensified. But there is another reason I think silver deserves special attention. Silver is not simply a smaller version of gold. It has an industrial economy attached to it. That means if the global economy remains strong enough to sustain demand from electronics, solar technology, and other industrial applications, silver can potentially benefit from both monetary and industrial forces. That creates an unusual setup. Gold can benefit from financial uncertainty. Silver can potentially benefit from financial uncertainty plus industrial demand. But there is a catch. If rising Treasury yields eventually produce a significant economic slowdown, industrial metals can suffer. So silver may experience much more volatility than gold. And that is why the $70 level is so psychologically important. The transcript argues that silver is approaching the $70 area and compares the current environment with the 1970s, when silver experienced an extraordinary move. The historical comparison is interesting, but we should not assume history will simply repeat itself. What matters more is the underlying mechanism. If silver breaks higher because investors are responding to a genuine deterioration in monetary confidence, while industrial demand remains strong, then the move could have a very different character from a short-term speculative spike. And that brings us to one of the most aggressive claims in the source material, the idea of a $275 silver target based on a long-term cup and handle pattern. I would treat that as a technical scenario, not a prediction that investors should assume will happen. Technical patterns can identify potential price objectives, but they cannot guarantee the future. The more important signal is what happens to the fundamentals underneath the chart. Does the dollar continue weakening? Do long-term yields remain elevated? Does the Treasury expand its intervention? Does the Fed eventually become more accommodative? Does physical silver demand remain strong? And most importantly, does the market begin to believe that the government can no longer stabilize the bond market through conventional tools alone? That final question could be the turning point, because if investors begin to believe that larger interventions are coming, the market may start pricing those interventions before they happen. And that is exactly what makes the current environment so unusual. The Treasury can buy bonds, the Federal Reserve can change interest rates, policymakers can provide liquidity, but none of those actions automatically eliminate the underlying debt. They can change the price and timing of the problem. They do not necessarily remove the problem itself. That is why the bond market is becoming such an important signal for precious metals investors. If Treasury yields stabilize naturally, the pressure could ease. If yields remain stubbornly high despite increasingly aggressive intervention, investors may start questioning how much control policymakers really have. And if that skepticism spreads into the currency market, gold could receive another wave of demand. Silver could then become the higher volatility expression of the same monetary story. So the real trade here is not simply buy silver because it is going to $275. The real trade is understanding the chain reaction, debt to treasury, yields to policy intervention to dollar to real rates to gold to silver, and right now, several links in that chain are moving at the same time. The question is what happens when the next link breaks. Because if the Treasury's first intervention was only the beginning, the next stage of this story could be much more important for gold and silver than the market realizes. Now, we need to take this one step further, because the real danger for the bond market is not simply that yields are high. The real danger is that investors begin to believe policymakers are losing control of the long end of the curve. And that is exactly why the recent Treasury intervention deserves so much attention. The Treasury has announced that it will double the size of certain buyback operations for longer-dated securities, while still maintaining the regular schedule of Treasury auctions. The stated purpose is to provide liquidity support to the market, not to establish an explicit interest rate target. But the market is watching the outcome. On August 25th, the 10-year Treasury yield was around 4.71%, while the 30-year yield was around 5.23%. That tells us something important. The Treasury can influence the market, but influencing the market is not the same thing as permanently controlling it, and this is where the debt problem becomes so important. If investors demand higher yields because they are worried about inflation, deficits, supply of government bonds, or the long-term fiscal outlook, the government cannot simply make those concerns disappear with a relatively small buyback program. The Treasury can improve liquidity, it can change the timing of purchases, it can potentially reduce pressure in specific parts of the curve. But the underlying borrowing requirement remains. That is why some market participants have questioned whether the intervention can have a lasting effect. Recent commentary has pointed out that the initial decline in yields was followed by a rebound, suggesting that the market is still testing the government's ability to influence long-term borrowing costs. And that is where the gold story becomes much more powerful. Because gold is beginning to behave as though investors are looking beyond the immediate level of interest rates. They are looking at financial credibility. If the Treasury intervenes more aggressively, investors may begin asking why. Is it simply a liquidity management operation, or is Washington becoming increasingly uncomfortable with the level of long-term borrowing costs? That distinction matters, because if investors conclude that policymakers are becoming more willing to intervene whenever yields rise too far, they may begin thinking about the long-term consequences. And one possible consequence is currency pressure. We are already seeing the relationship. When Treasury buyback expectations pushed yields lower, gold surged sharply. Gold has also remained elevated as investors worry about U.S. fiscal policy and the dollar. So the market is effectively saying, if the government becomes more aggressive in supporting the bond market, gold becomes more interesting. Not because every bond purchase automatically creates inflation, but because investors understand the broader policy dilemma. The United States has to finance a huge amount of debt. It has to maintain functioning treasury markets. It wants to avoid excessively high borrowing costs. And at the same time, it has to maintain confidence in the dollar and prevent inflation expectations from becoming unanchored. Those objectives can conflict, and that conflict is where precious metals can thrive. Gold does not have to beat treasury bonds because of yield. It simply has to become more attractive as a store of value when investors become less comfortable with the long-term purchasing power of financial assets. Silver takes that argument one step further, because silver has a monetary component, but it also has industrial demand. If the global economy stays reasonably strong, silver can benefit from industrial applications while simultaneously receiving monetary support from the precious metals cycle. But if the economy deteriorates badly, silver could initially behave very differently from gold. That is why I would not treat silver as simply gold with more upside. It is a different asset. And that difference becomes especially important if the bond market problem turns into a broader economic slowdown. Imagine the next sequence. Treasury yields remain elevated, the government increases intervention, the dollar weakens, the Federal Reserve eventually becomes more supportive. Real yields decline, gold breaks higher, silver follows, but with greater volatility. That is one possible path. The opposite path is also possible. Inflation remains stubborn. The Fed stays restrictive. Real yields rise. The dollar strengthens. Gold consolidates. Silver becomes vulnerable to both higher real yields and weaker industrial expectations. That is why the upcoming inflation data and Jackson Hole policy signals matter so much. Markets are currently watching both for clues about the future path of monetary policy. But there is one thing I think investors should watch even more closely. What happens when Treasury intervention meets actual market demand? If the government buys bonds and yields remain under control, the market may gradually accept the policy. But if the Treasury keeps buying and long-term yields continue climbing, that would send a very different message. It would suggest that the market's underlying concerns are stronger than the intervention. And that could become a major signal for gold, because then investors are no longer simply debating whether the Treasury will buy bonds. They are asking whether Washington can keep borrowing at acceptable rates without increasingly relying on policy intervention. That is a much bigger question, and it brings us back to the most controversial argument in the source material, the possibility that today's Treasury intervention could eventually be followed by much larger measures. The transcript suggests that outright money creation or a future form of quantitative easing could eventually become necessary. But I want to be very clear here. That is a scenario, not a confirmed policy decision. There is no guarantee that the United States will move toward traditional QE simply because Treasury buybacks have increased. The Treasury itself describes the current operation as liquidity support, and the Federal Reserve remains a separate institution with its own monetary policy framework. Still, the fact that investors are even debating these possibilities tells us something about market psychology. Confidence is becoming part of the trade. And when confidence becomes part of the trade, gold becomes much more important. Because gold is ultimately a confidence asset. When confidence in currencies is high, people have little reason to hold large amounts of gold. When confidence weakens, gold becomes more attractive, and silver can become the more aggressive expression of that same theme. That is why the next move may not be determined by a single inflation report, a single Fed speech, or a single Treasury announcement. It may be determined by whether investors believe the current financial system can continue operating under the weight of enormous debt without increasingly extraordinary intervention. And if that confidence starts to crack, the precious metals market could enter a completely different phase. Because at that point, gold is no longer simply reacting to inflation. Silver is no longer simply reacting to industrial demand. Both metals become part of a much larger question. How much confidence does the market still have in the ability of policymakers to manage the debt problem without weakening the currency or destabilizing the bond market? That is the question I would be watching. So where does all of this leave gold and silver investors? After everything we have looked at, I think the most important point is this. The story is no longer simply about whether silver can reach $70. It is about whether the financial environment developing around silver and gold can support a much larger repricing over time. And there are several pieces of that puzzle already on the table. The United States has crossed the $40 trillion national debt milestone discussed in the source material. Long-term Treasury yields remain elevated. The Treasury has increased the size of certain bond buyback operations. The dollar has come under pressure at points when bond market concerns intensified, and gold has responded strongly to those developments. None of this proves that a debt crisis is inevitable. None of it proves that the Treasury will eventually begin traditional money printing, and it certainly does not prove that silver must reach $275. But it does tell us that the financial system is entering a period where investors need to pay much closer attention to the interaction between debt, interest rates, currencies, and precious metals. That is the real opportunity. Let's start with gold. Gold remains the cleaner monetary hedge in this entire equation. If Treasury yields decline, if real yields fall, if the dollar weakens, or if investors become increasingly concerned about government finances, gold can benefit. And if the Federal Reserve eventually becomes more accommodative, that could provide another potential tailwind. But there is an important warning. If inflation remains stubbornly high and the Fed maintains restrictive policy, gold could experience periods of consolidation or sharp corrections. That is normal. A long-term bullish thesis does not mean prices move in a straight line, and silver is even more volatile. Silver is approaching a major psychological level around $70, and the source material argues that the metal could eventually move far beyond that level based on its long-term technical structure. One-sided analysis places a potential target around $275 using a large cup and handle pattern. I would treat that number as a high-end technical scenario, not as a guaranteed forecast. The important question is what would have to happen for a move of that magnitude to become plausible. You would likely need some combination of strong monetary demand, persistent investor interest, constrained supply, continued industrial demand, and a broader commodity bull market. And there is another factor that deserves attention. Silver's industrial role is becoming increasingly important. The source highlights applications ranging from solar panels and electric vehicles to electronics and other technologies, arguing that silver could increasingly function as a strategic industrial metal. That is a powerful combination. Gold is primarily monetary, copper is primarily industrial, silver sits between them. So if the next phase of the commodity cycle combines monetary instability with continued industrial demand, silver could potentially become one of the most volatile metals in the entire market. But again, there is a major caveat. Industrial demand also means economic sensitivity. If the global economy enters a deep recession, silver could initially suffer more than gold. That is why I would watch the relationship between the two metals rather than focusing on one price target. If gold continues making new highs while silver begins accelerating faster, that could indicate increasing speculative and monetary participation in silver. If gold rises while silver struggles, investors may be signaling greater concern about economic growth. And if both metals rise together while the dollar weakens and real yields fall, that would be a much stronger confirmation of the broader monetary thesis. That is the signal I would watch. Now let's return to the Treasury market. The biggest question for the next year is not whether the government will buy another few billion dollars of bonds. The bigger question is whether these interventions remain relatively small liquidity operations, or whether policymakers eventually need much larger measures to stabilize financial conditions. The source material makes the argument that the initial intervention could be only the beginning. Again, that is an interpretation, but markets often move before policy becomes obvious. If investors begin anticipating larger interventions, they may start positioning for weaker real yields and a softer dollar before those policies are formally announced. And that could create a powerful environment for gold. Silver could then potentially follow with much greater volatility. This is also why the debt warnings from investors such as Ray Dalio have attracted attention. The source cites his view that the U.S. fiscal situation is approaching an inflection point and that investors should consider precious metals as part of a defensive strategy. But again, we should distinguish between a warning and a prediction. A debt crisis is not guaranteed. The United States still has enormous economic resources, deep capital markets, and the world's dominant reserve currency. The question is how those advantages interact with the scale of the debt burden over time. And that is why I think the most useful way to approach this market is not with certainty, it is with scenarios. Scenario 1, the Treasury interventions work, long-term yields stabilize, inflation cools, and the dollar remains relatively strong. In that environment, gold and silver could experience periods of consolidation. Scenario 2, the Treasury needs to intervene more aggressively, real yields decline, the dollar weakens, and investors increasingly seek protection from fiscal and monetary uncertainty. That could be significantly more bullish for gold and potentially even more explosive for silver. Scenario 3, the economy enters a serious slowdown while inflation remains problematic. Can silver reach $70? The bigger question is, what happens to silver if the financial system needs even more intervention? That is the question I will be watching. And if the answer is what the most bullish scenarios suggest, we may look back at $70 silver as only the beginning of a much larger story. As always, verify the data, understand the risks, and do your own research before making any investment decision. This is macroeconomic analysis, not personalized financial advice. Because in a market driven by debt, policy, and confidence, the biggest opportunity may not come from predicting the exact price. It may come from understanding why the price is moving in the first place,